The world is panicking. Oil is pushing toward $120 a barrel. The Strait of Hormuz is a geopolitical tinderbox, and every time you refresh your brokerage app, the sea of red gets deeper. But while the average retail investor is frozen in fear, the smartest money on Wall Street is doing something very different. They are moving into the war-proof energy giant. We are talking about ExxonMobil, ticker symbol XOM. Now, I know what you're thinking. Why oil? Why now? Isn't the world moving toward green energy? Look at the reality of March 2026. Global energy demand is at an all-time high, and the supply chain is fractured. ExxonMobil isn't just an oil company anymore. It is a global energy infrastructure play that has survived every single market crash, world war, and recession since the 19th century. Let's talk about the dividend first, because that is why we are here. Exxon is a dividend aristocrat with 43 consecutive years of payout increases. Think about that for a second. They raised the dividend through the 1980s inflation crisis, the dot-com bubble, the 2008 financial collapse, and the global lockdowns. If you are looking for a sleep well at night stock while the world feels like it's falling apart, this is the gold standard. But here is the viral secret that most analysts are missing right now: the integrated model. Most oil companies are pure plays. They either pump the oil or they refine it. When the price of crude oil spikes like it's doing today, the pumpers win but the refiners lose because their raw material costs go through the roof. Exxon is different. They own the entire vertical. When crude oil hits $120, their upstream profits explode. But if the market overcorrects and oil prices crash back to $70, their refining and chemical margins expand to provide a massive financial floor. It is a self-hedging machine. Currently, Exxon is sitting on a massive mountain of cash. They've spent the last 3 years cleaning up the balance sheet, and their break-even cost is now incredibly low. We're talking below $35 a barrel. That means even if the world finds peace tomorrow and oil prices drop by 50%, ExxonMobil is still printing money and, more importantly, still paying your dividend. Look at the charts from this morning. While the S&P 500 is struggling to find a bottom, XOM is showing what we call relative strength. It's holding its gains. It's the flight to safety stock for institutional investors. When the world is panicking, big money doesn't go into speculative AI startups or high-growth tech that doesn't make a profit. They go into companies that own physical assets, have massive pricing power, and a history of rewarding shareholders no matter what. If you are tired of the volatility and you want a stock that actually benefits from the current global chaos instead of being a victim of it, Chapter 1 of your Panics portfolio starts right here with Exxon. They aren't just surviving the 2026 energy crisis, they are capitalized to dominate it. Before we move to Chapter 2, which is a digital landlord play that literally cannot be disrupted by the internet, make sure you've noted down XOM. This is your anchor. This is the stock that keeps your portfolio green when everything else is bleeding red. Let's dive into the next one. Now that you've secured your portfolio with an energy giant like Exxon, we need to talk about where you're going to park your money when the actual ground beneath the stock market starts to shake. We're moving from the oil fields to something much more tangible: real estate. But I'm not talking about risky office buildings or empty downtown high-rises that everyone is fleeing in 2026. I'm talking about the ultimate digital landlord. We are looking at Federal Realty Investment Trust, ticker symbol FRT. If you want to talk about elite status, listen to this: Federal Realty is a dividend king. There are only a handful of companies on the entire planet that have raised the dividend every single year for over 50 consecutive years. Federal Realty has done it for 57. Think about what the world has gone through since 1967. We've had stagflation, the Cold War, the Great Recession, a global pandemic, and now the massive 2026 market reset. Through every single one of those world-ending events, Federal Realty didn't just pay their investors, they gave them a raise. Why is this stock so resilient when other real estate companies are collapsing? It's because of the essential retail strategy. They don't own massive, dying suburban malls. They own high-end, open-air shopping centers in the most affluent zip codes in the country. We're talking about places where the average household income is double the national average. But here is the viral secret: their properties are grocery-anchored. In March 2026, people might be canceling their high-priced tech subscriptions, they might be skipping the luxury vacation, and they might be selling their speculative AI stocks in a panic. But they are still going to the grocery store. They are still going to the pharmacy. They are still getting their hair cut and buying essentials. Federal Realty owns the land that those essential businesses sit on. When the world is panicking, the essential businesses stay open, and they keep paying their rent to Federal Realty, who in turn keeps paying that dividend to you. Currently, FRT is offering a yield of around 4.3%. In a world where the S&P 500 yield is hovering at historical lows, getting over 4% from a dividend king is an absolute steal. But the real reason this is a panic buy is the valuation. Because people see the word real estate and they run for the hills, they are throwing the baby out with the bathwater. They are selling Federal Realty at a discount because they think it's just another REIT. It isn't. It is a fortress. Look at their occupancy rates. Even now, with all the talk of a consumer slowdown, Federal Realty is maintaining occupancy in the mid to high 90% range. Why? Because retailers know if they lose a spot in a Federal Realty center, they will never get it back. These are the trophy assets of the retail world. If you are looking at your portfolio today and you see nothing but volatility and uncertainty, you need a digital landlord that provides a physical floor for your wealth. Federal Realty gives you exposure to the strongest consumers in the country without the headache of actually managing a property. You are getting a piece of the best land in America, and you are getting paid a growing check every 3 months just for holding it. When the market finally realizes that essential retail is the safest place to be during an inflation spike, this stock is going to catch a massive bid. But by then, the yield will be lower and the price will be higher. The time to buy a dividend king is when the rest of the world is too scared to look at the ticker. Lock in FRT as your second anchor. It's the brick and mortar defense your portfolio needs to survive the rest of 2026. Now, let's move to Chapter 3, where we're going to look at a green utility that is actually an inflation-fighting machine. After anchoring your portfolio with energy and essential real estate, we need to address the elephant in the room for 2026, the energy bottleneck. Between the massive data center expansion for AI and the global push for energy independence, the world is starving for power. That's why Chapter 3 is dedicated to the ultimate inflation hedge and a global leader in clean energy, Brookfield Renewable, ticker symbol BEPC. Now, don't let the renewable label fool you into thinking this is some speculative green tech gamble. Brookfield is a specialized utility powerhouse backed by the trillion-dollar Brookfield ecosystem. They don't just build wind farms, they own the most critical, baseload, power source in the world, hydroelectric dams. In March 2026, while solar and wind are great, the massive AI data centers owned by Microsoft and Google need 24/7, always-on power. That is exactly what Brookfield provides. Here is the viral hook for this stock. Energy independence is no longer just a policy goal, it's a national security mandate. With the 2026 geopolitical climate being as volatile as it is, countries are desperate to decouple from foreign gas and coal. Brookfield is the primary partner for governments and tech titans looking to secure domestic, reliable energy. They recently signed a landmark framework with Google for hydroelectricity that is quite literally the largest of its kind in history. But let's get into why this is a panic buy for dividend seekers. Brookfield has a unique inflation escalator built into nearly all of its long-term contracts. Roughly 70% of their revenue is explicitly linked to inflation. That means when the cost of living goes up and the dollar loses value, Brookfield's cash flow automatically adjusts upward. It is one of the few businesses on the planet where inflation is actually a tailwind for the dividend. Speaking of the dividend, Brookfield just announced a 5% increase for 2026, bringing their annual payout to $1.57 per share. They've maintained at least 5% annual growth since they went public in 2011, and they are targeting double-digit growth in funds from operations through 2030. You are getting a current yield of nearly 4% on a company that is growing its earnings faster than most tech stocks. Why buy it while the world is panicking? Because high interest rates and macro fear have pushed utility stocks down to levels we haven't seen in years. Most investors are obsessed with Nvidia or OpenAI, but they are forgetting that those AI models can't run without the power that Brookfield generates. You are buying the picks and shovels of the AI revolution, but with a massive dividend yield and a rock-solid balance sheet. Brookfield Renewable is also incredibly smart about how they manage their money. They are masters of capital recycling. They build a project, de-risk it, sell a portion of it to a pension fund at a massive profit, and then plow that cash into even bigger projects. In 2025 alone, they generated over $4 billion from asset sales. This is a business that knows how to create value in both bull and bear markets. If you want to profit from the 2026 energy crisis while protecting your purchasing power from inflation, BEPC is the play. It's the green utility that pays you like a value king. Note this down as your third pillar. Next, in Chapter 4, we're going into a safe haven that has become a staple for every market crash in history. We're going to look at the one stock Warren Buffett says he will never sell. When the world is in a full-scale panic, investors often make the mistake of looking for the next big thing to save them. But the smartest investor in history, Warren Buffett, does the exact opposite. He looks for what people are going to be doing no matter how bad the economy gets. And in March 2026, that leads us straight to Chapter 4, the ultimate safe haven staple, Coca-Cola, ticker symbol KO. Right now, as we sit in the middle of this 2026 market reset, Coca-Cola has just hit a massive milestone that every dividend investor needs to pay attention to. In February, they officially raised the dividend for the 64th consecutive year. Think about that longevity, 64 years of constant raises. That means this company has increased its payout through the Vietnam War, the 1970s stagflation, the Great Recession, and the entire AI revolution. Here is the viral secret about KO that most people miss. It's not just a soda company, it is a global licensing and branding powerhouse. Coca-Cola operates an asset-light model. They don't own most of the bottling plants or the delivery trucks, they own the secret formula and the brand. This allows them to maintain incredible profit margins, currently crossing 32%. While other companies are struggling with rising labor and manufacturing costs in 2026, Coca-Cola just passes those costs on to the consumer. This is what we call pricing power. If the price of a Coke goes up by 10 cents, people still buy it. That tiny increase, multiplied by 2.2 billion servings a day, translates into massive cash flow for you. In fact, the numbers for 2026 are looking better than they have in a decade. Management is projecting $12.2 billion in free cash flow this year. That is a massive jump that completely secures the dividend. They've even moved past their recent leadership transition, with Henrik Braun taking over the CEO seat, focusing heavily on digital integration and capturing the youth market in emerging economies like India and China. Currently, KO is yielding about 2.8%. Now, I know what you're thinking, that doesn't sound as high as a REIT, an energy stock. But you have to look at the yield on cost. Warren Buffett's Berkshire Hathaway collects nearly $850 million a year in dividends from Coke alone. Because he bought in early and held while they raised the dividend every single year, his actual return on his original investment is astronomical. That is the goal of this panic portfolio, buying world-class assets at a discount so that 10 years from now, your yield on cost is into the double digits. The stock is currently trading around $75, which is nearly 8% off its recent highs. In a world of panic, a blue-chip king like Coca-Cola being on sale is a gift. Analysts have a mean price target in the mid-80s, but the real story here is the stability. Coca-Cola has a beta of 0.35. For those of you who aren't math nerds, that means when the rest of the market is swinging wildly by 10 or 20%, Coke barely moves. It is the anchor that stops your portfolio from drifting away during a storm. If you are looking for a place to hide while the headlines get scarier, you go where the world's most successful investors go. You buy the brand that everyone recognizes, that everyone consumes, and that pays you more every single year without fail. Note down KO as your fourth pillar. Now, let's move to Chapter 5, where we're shifting into the world of healthcare royalty. We're looking at a company that owns the patents on life-saving technology, medical tech that is literally recession-proof. As we transition from the consumer staples of Coca-Cola, we enter a sector that isn't just about what people want, it's about what they literally cannot live without. Welcome to Chapter 5, the healthcare royalty of the 2026 market, Medtronic, ticker symbol MD-T. If you're looking for a recession-proof titan, this is it. In March 2026, while the rest of the tech world is sweating over speculative AI valuations, Medtronic is quietly proving why it is a cornerstone of the panic portfolio. This company is the largest medical device manufacturer in the world, and right now, it is sitting on a massive catalyst that the mainstream media is completely overlooking. First, let's talk about the dividend shield. As of this week, Medtronic has officially maintained its status as a dividend aristocrat for 48 consecutive years. Think about that, they have raised their payout every single year since 1978. In a 2026 economy where cash is king, MDT is currently yielding a rock-solid 3.3%. With a quarterly dividend of 71 cents per share, they are distributing billions back to shareholders while maintaining a payout ratio that is well covered by their massive cash flow. But here is the growth engine that is going to drive this stock higher through the rest of 2026, the Hugo robotic-assisted surgery system. For years, Intuitive Surgical had a monopoly on this space. Not anymore. Medtronic's Hugo system has finally secured major FDA clearances for general surgery and urologic procedures. We are seeing a valuation re-rating happen in real time. While Intuitive Surgical trades at an astronomical P/E, Medtronic is still priced like a legacy hardware company, trading at roughly 16 times forward earnings. As Hugo rolls out across US hospitals this quarter, that conglomerate discount is going to evaporate. Furthermore, Medtronic just hit a triple threat in their Q3 2026 earnings report. They beat on EPS, they beat on revenue, and they raised their organic growth guidance to 5.5%. Their cardiovascular portfolio is exploding, specifically their pulse field ablation technology, Pulse Select. This is a revolutionary way to treat heart arrhythmias using electric fields instead of extreme heat or cold. It's safer, it's faster, and Medtronic was the first to market. They aren't just participating in the medical tech race, they are lapping the field. And for the strategists watching the balance sheet, keep an eye on the mini-med spin-off. Medtronic is currently finalizing the IPO of its diabetes division. By shedding this volatile, high-RD segment, the new Medtronic is going to emerge as a higher-margin, leaner machine focused on high-growth areas like neurovascular care and structural heart. This is a classic, value unlock, play that we love to see during market resets. Currently trading around $90, MDT is at a significant discount to its intrinsic value, which analysts place closer to $112. You are getting a world-class innovator with 48 years of dividend growth at a bargain basement price. In a world of uncertainty, you want to own the company that owns the patents on the literal pacemakers and surgical robots keeping the world's aging population alive. Note down MDT as your fifth pillar. You aren't just buying a stock, you're buying a royalty on the future of human health. Now that we've built a foundation in energy, essential retail, power, and healthcare, we have to talk about the gold standard for consistent income. If you are panicking because the market is swinging 3% every single day, you need a stock that pays you not every year, and not even every quarter, but every single month. Welcome to Chapter 6, the monthly dividend company, Realty Income, ticker symbol O. In the 2026 market, cash flow is king. While other investors are waiting 90 days to see a dividend check, Realty Income shareholders are getting paid 12 times a year, like clockwork. They have declared over 640 consecutive monthly dividends. Think about that consistency. They haven't just paid it, they have increased that dividend for over 105 consecutive quarters. Whether we are in a soft landing, a hard landing, or a no landing scenario in 2026, Realty Income is the fortress that keeps your bank account green. But here is the viral secret that the bears are missing, the triple net lease advantage. Realty Income doesn't operate like a normal landlord. In a triple net lease, the tenant, companies like Walgreens, 7-Eleven, and Dollar General, is responsible for the property taxes, the insurance, and all the maintenance. When inflation spikes the cost of roofing or plumbing in 2026, Realty Income doesn't pay a dime of it. Their overhead is incredibly low, which allows them to pass almost all of their rental income directly to you. Right now, as we sit in March 2026, Realty Income is making a massive strategic pivot that is going to define the next decade of real estate. They are moving aggressively into data center infrastructure and European expansion. They recently closed a $900 million joint venture to fund massive AI data centers. They aren't just owning the local pharmacy anymore, they are owning the physical buildings that house the servers running the AI revolution. Currently, the stock is yielding a massive 5.8%. In a world where the risk-free rate on government bonds is starting to fluctuate, locking in nearly 6% from a company with a credit rating of A- is a generational opportunity. The market has been punishing REITs because of interest rate fears, but Realty Income has a cost of capital advantage that their competitors simply can't match. They can borrow money cheaper than almost anyone else in the industry, which means they can buy properties at a profit even when rates are high. Look at the occupancy resilience. Even during the height of the 2026 consumer squeeze, Realty Income's occupancy has stayed above 98%. Why? Because they only lease to investment-grade tenants who provide non-discretionary services. When people are worried about the economy, they don't stop going to the convenience store or the discount retailer. Realty Income owns the most productive corners in America. The stock is currently trading around $54, which is a significant discount from its intrinsic value of nearly $68. You are essentially buying the bank of real estate at a 20% discount. For a dividend investor, this is the ultimate volatility buffer. When the news is screaming about a market crash, you can look at your account and see that monthly deposit from ticker symbol O, and you know your strategy is working. Note this down as your sixth pillar. It is the monthly paycheck that turns a panic into a plan. Now, we are heading into Chapter 7, the Infrastructure King. We're going to look at the Energy Highway of North America, a company that moves the fuel that keeps the lights on, no matter what happens to the price of oil. We have reached the final chapter of our Panics portfolio. We've covered everything from global energy and essential retail to life-saving medical tech. But for the final piece of the puzzle, we are looking at the company that owns the Energy Highway of North America. When the world is panicking over oil prices or geopolitical instability, you want to own the pipes. That is why Chapter 7 is dedicated to Kinder Morgan, ticker symbol KMI. If you want to understand why Kinder Morgan is a panic buy in March 2026, you have to look at their footprint. They operate approximately 79,000 miles of pipelines. They move nearly 40% of all the natural gas consumed in the United States. Think about that, almost half of the gas used to heat homes, cook food, and power the massive AI data centers we've been talking about flows through Kinder Morgan's infrastructure. In a world of uncertainty, this is the ultimate toll booth business. They don't care if the price of gas is high or low, they get paid for every molecule that moves through their pipes. Here is the viral secret for 2026, the natural gas renaissance. While the world has been obsessed with the transition to renewables, 2026 has proven that the global economy cannot run without natural gas as a baseload fuel. Kinder Morgan is sitting on a record backlog of projects, over $9 billion worth, including the massive Trident pipeline and the Southern North expansion. They are quite literally building the infrastructure that will power the next decade of American energy independence. Now, let's talk about the income. Kinder Morgan just updated the guidance for the full year of 2026, and the numbers are a dream for dividend investors. They are projecting an annualized dividend of $1.19 per share. This marks the 9th consecutive year of dividend increases. Currently, that puts the yield at a very attractive 4.3 to 4.5%, depending on the daily market swings. But more importantly, they are doing this while maintaining an incredibly strong balance sheet. Their net debt to EBITDA ratio is forecast to end the year at 3.8 times, which is at the low end of their target range. What makes KMI different from the speculative stocks currently bleeding out in the market is visibility. Roughly 95% of their earnings are supported by regulated rate structures or long-term, fee-based contracts. This isn't a company that hopes to make a profit next quarter. This is a company that has already contracted out its capacity for years in advance. In March 2026, visibility is the rarest and most valuable commodity on Wall Street. Currently, the stock is showing massive momentum, but it is still trading at what many analysts consider a deep value level. With a price target in the mid-30s and a safe, growing 4% plus yield, you are getting the best of both worlds, capital appreciation and high-octane income. While the impression paradox makes most investors chase the latest trend, you are buying the physical assets that make the modern world possible. So, there you have it. 7 stocks for 7 chapters. From the oil fields of Exxon to the pipelines of Kinder Morgan, you now have a complete, diversified, and war-proof portfolio designed to thrive while the rest of the world is in a panic. You have the energy, the real estate, the power, the staples, the healthcare, and the infrastructure. Note down KMI as your final pillar. This is the energy highway that completes your journey to financial resilience in 2026.